Hi, welcome to Leeb.com, Leeb.com. Today's Monday, August 3rd. Be sure to sign up for our free electronic newsletter if you haven't done so already. And if you do, we'll send you a copy of our 12-page monthly devoted to income, Leeb's Income Performance Letter. Well, turning to the markets today, the S&P climbed above 1,000 as expected. It's gaining a lot of attention, and it certainly has been a powerful move. But we think the real story right now is in commodities, which have also been on fire. The Commodity Research Bureau's index is up 33% from its February lows. It's highly unusual to see stocks and commodities moving up like this so powerfully in the same direction. In fact, it's only the third time in post-war history we've had such a big advance in commodities in such a short span of time. The first time, in 1950, the U.S. economy was growing at a double-digit rate. Oil was the equivalent of $23 in today's dollars, and not surprisingly, stocks soared at that time. The second occurrence was in 1973. Again, the economy was going great guns. GDP was growing almost at 6.5%. Back then, stocks inched a bit higher, but then dropped 44% as a recession set in due to rising commodity prices. Today, we have a very weak economy. And a similar decline in stocks would take us back well below the March lows. Rising energy prices really hold the key. And if they merely hold steady, by December, we're going to be in trouble again. The energy story, the world's dire oil situation is starting to gain some traction. Over the weekend, we heard from Dr. Fatih Briol, the chief economist at the IEA, the International Energy Agency. IEA is tasked by the OECD nations, the generally largest economies in the world, with keeping track and forecasting where energy is heading. Last year, they did a field-by-field study of the global oil patch, and in it, they greatly lowered their expectations for world production going forward. Well, they're getting ready for a follow-up assessment, and it looks like it's going to be even more pessimistic than last year. Briol is warning that oil is running out faster than previously expected, and it's expected that he's going to say that global production should peak in about 10 years. Keep in mind that the IEA tends to be overly optimistic, and there certainly is plenty of data to support the claim that we are already past peak. Now, being past peak doesn't mean that we're going to run out of oil tomorrow, but it does mean that the flow of oil is going to drop off dramatically. The IEA is expecting oil production to decline in existing fields is now running at 6.7% or so. That's versus a prior estimate of 3.7% decline for existing fields. Keep in mind that oil service company giant Schlumberger's Andrew Gould suggests that the rate is closer to 8%. And Gould is certainly in a great position to judge that. He also sees no drilling going on with oil prices below $70. Well, we're above that now, and if we stay here, we'll start to see some pickup, but it's not going to be enough to stave off that decline in production. So the bottom line here is we are in a tough situation, and you really want to start rooting for a pullback in crude prices to keep things afloat. That's all for now. Thanks for stopping by, and hopefully we'll see you again soon.